Imagine two guys, same age, same salary, same starting point. One of them spends his evenings glued to his phone, watching charts go up and down, buying and selling stocks almost every single day. He's constantly researching, following financial news, reacting to every market move. He feels busy, he feels smart, he feels like he's doing something. The other guy? He set up a simple investment account, put in a fixed amount every month, and then went back to living his life. He barely checks it. He doesn't lose sleep over market crashes. He doesn't celebrate every green day. Fast forward 10 years. Who do you think has more money? If you said the first guy, the active trader, you're not alone. Most people would guess the same thing. But the data tells a completely different story. And once you understand why, it'll change the way you think about money forever.
Here's the thing about trading. It feels powerful. You're in control, you're making decisions, you're reacting to a real information in real time. Every time you make a good trade, your brain releases a little hit of dopamine, the same chemical that fires when you win a game or nail a job interview. That feeling is so compelling that millions of people are convinced trading is the fast lane to wealth. Social media makes it worse. You see the highlight reels. The guy who turned 5,000 into 50,000 in 6 months. The girl who quit her job to trade full-time. The influencer with the Lambo and the laptop. Nobody posts about the losses. And here's the brutal truth that the finance industry doesn't make it easy to see. Most traders lose money. Not a few, not some. Studies consistently show that somewhere between 70 and 90% of retail traders, regular people like you and me, lose money over the long run. So why do so many people keep doing it? And why does everyone think they'll be the exception?
Let's break down what trading and investing actually are, because most people mix them up. Trading is buying and selling financial assets, stocks, currencies, crypto, over short periods of time. We're talking days, hours, sometimes minutes. The goal is to profit from price swings. Buy low, sell high, fast. Repeat. Investing is buying assets and holding them for years, sometimes decades. The goal isn't to catch every wave. It's to grow with the overall direction of the market over time. Think of it like this. A trader is like a surfer trying to catch every single wave. Some waves are great, some wipe them out, and they spend a ton of energy paddling, watching, waiting, and recovering. An investor is like someone who owns a beach hotel. They're not riding every wave, but year after year, people keep coming to the beach. The hotel gets more valuable, the money rolls in while they sleep. Now, here's where the math gets really interesting. The stock market, specifically the S&P 500, has returned about 10% per year on average over the long term. That means if you invested a lump sum and just left it alone, you'd roughly double your money every 7 years. Not because you were clever, not because you made the right calls, just because time and compounding did the work for you. A trader, to beat that, has to not only pick the right stocks, they have to do it consistently, after taxes, after trading fees, and after accounting for the times they get it wrong. That's incredibly hard. Even professional fund managers, with teams of analysts and access to information that you and I don't have, fail to beat the market index more than half the time.
So why do people keep trading if the odds are so stacked against them? This is where psychology comes in, and it's fascinating. Our brains are wired to believe we're above average. Psychologists call it the overconfidence bias. When a trade goes right, we think it's because we were smart. When it goes wrong, we think it was bad luck, a fluke, something out of our control. So we never actually update our belief that we're good at this. There's also something called the illusion of control. When you're actively doing something, buying, selling, researching, reacting, it feels like you're in control. Doing nothing, even when doing nothing is the smarter move, feels uncomfortable. It feels lazy. It feels like you're leaving money on the table. But here's the counterintuitive truth. In investing, inactivity is often the most powerful thing you can do. There's a famous study that found the best performing investment accounts at a major brokerage were the ones that had been forgotten. The owners had either passed away or simply stopped logging in. They didn't panic during crashes. They didn't sell at the bottom. They didn't chase hot trends. They just held. The market rewards patience in a way it almost never rewards cleverness. And here's something else that doesn't get talked about enough. Trading has a hidden tax problem. Every time you sell a stock for a profit within a year, you pay short-term capital gains tax, which gets taxed at your regular income rate. So even if you make money trading, the IRS takes a bigger cut. Long-term investors pay a lower capital gains rate. It's another built-in disadvantage that quietly eats into a trader's returns year after year.
Now, none of this means it's impossible to make money trading. Some people do, but they're the exception. They're usually professionals, and even most of them underperform a simple index fund over time. So what should you actually do? Start simple. You don't need to pick individual stocks. You don't need to watch charts. You can buy a broad index fund, something that tracks the overall market, like a total market or S&P 500 fund, and add to it consistently every single month. This strategy is called dollar cost averaging. You invest a fixed amount on a regular schedule, whether the market is up or down. Over time, this smooths out the bumps and lets compounding do the heavy lifting. Time in the market beats timing the market every single time. If you're 25 and you start investing even a small amount consistently, you will almost certainly end up wealthier than someone who spent years trying to pick winners and catch trends. Because compounding doesn't need you to be clever. It just needs you to show up and be patient. The boring strategy is the winning strategy. The exciting one is usually the expensive one.
Here's the thought I want to leave you with. We live in a world that rewards action. Move fast, do more, react quicker. And so when it comes to money, we naturally assume the person doing the most must be winning the most. But wealth building doesn't work that way. The wealthiest people in history, the Warren Buffetts of the world, didn't get rich by being the fastest or the most reactive. They got rich by being the most patient. By understanding that real wealth gets built quietly, slowly, and almost boringly over decades. Trading sells you the dream of getting rich fast. Investing gives you the reality of getting rich steadily. And in the long run, steady almost always wins. So the next time you're tempted to open a trading app and jump on the latest hot stock, ask yourself one simple question. Am I doing this because it's smart or because it feels exciting? Because your financial future depends entirely on your ability to tell the difference.
If you found this video helpful, hit like and subscribe for more simple finance lessons. Keep learning, keep improving, and remember, small financial decisions today can lead to bigger wealth tomorrow. Thanks for watching, and see you in the next video.